The balance of payments records all the economic transactions between a country and the rest of the world. It tracks the inflow and outflow of money associated with transactions related to movement of goods and services, which is called trade, along with investments and capital. The balance of payments are classified into three components: the current account, capital account, and the financial account. Sometimes the capital and financial accounts are clubbed together as capital account. The current account includes the inflow and outflow of goods and services into a country. The inflow of goods from abroad is called imports, while the goods sent to other countries are called exports. Additionally, the earnings from investments made abroad, for example dividends on stocks held in a foreign country, are included in the current account. It also includes incomes earned by citizens from abroad or remittances sent from a foreign country. Trade of goods can include raw materials like iron or crude oil, intermediate good which are used in manufacturing of other goods like engine of a car, finished goods like cars or laptops, or capital goods like machines. The services trade include delivery of services like tourism, transportation services, or service fees for business consultancy. Now we will briefly discuss how these transactions are recorded in the current account. The exports are recorded as positive because they lead to receipt of money. Imports are recorded as negative because money is required to be paid. Similarly, remittances received from abroad are recorded as positive while remittances sent abroad are negative. Same goes for dividends or interest income. The difference between exports and imports is termed as balance of trade. When the exports of a country exceed the imports, the country is said to have a trade surplus. In case the imports exceed the exports, the country runs a trade deficit. Similarly, if the overall receipts in the current account exceed the payments, the current account is said to be in a surplus. If the payments exceed the receipts, the country runs a current account deficit. According to the World Bank, in 2023, 94 countries had a current account deficit, out of 160 countries for which the data were available. A country's current account can register a surplus or deficit depending on various factors like the exchange rate of its currency, competitiveness of its exports, or its trade policies. For example, if the currency of a country is undervalued, that is, its exchange rate is lower than it ought to be, its export goods become cheaper abroad. This leads to a rise in the exports and contribute to a surplus in the current account. In contrast, an overvalued currency can make the exported goods expensive and imported goods cheaper, leading to an increase in the deficit. Similarly, countries with low labor wage rate can make goods at lower costs, increasing the competitiveness of their exports. This is the reason it is cheaper to manufacture iPhones in Asia rather than the US or Europe. Countries can also put tariffs on goods imported from abroad, leading to increase in their prices. Rise in prices of imported goods lowers their demand and cuts down the current account deficit. Economists consider a large current account deficit bad for the economy. It can lead to depreciation of the currency. This happens because, as imports exceed exports, the demand for the currency decreases. It can deplete a country's foreign exchange reserves. As imports are more than the exports, the dollar outgo due to imports is more than the dollar inflow due to exports, leading to fall in the reserves. To finance the deficit, the country may have to borrow more, increasing its debt. A persistently high current account deficit can lead to balance of payment crisis in the long run. A current account deficit is often accompanied by a surplus in the capital and financial account. We will explain this shortly, but let's first talk about the capital account. The capital and financial account is the other major component of balance of payments account. The capital and financial account records all transactions related to flow of investments into and out of the economy. While the current account is related to income, capital and financial account is related to ownership of assets. In the capital account, the inflow of investments by foreigners in the domestic economy is treated as surplus in the capital account. Outflow of investments by nations' citizens in foreign countries is treated as a deficit. The capital account includes foreign direct investments, portfolio investments, other investments, and reserve account. Foreign direct investment, or the FDI, refers to long-term capital investment, such as the purchase or construction of machinery, buildings, or manufacturing plants. However, profits from these investments, that are not reinvested, are counted in the current account. Portfolio investment refers to the purchase of shares, bonds, and other securities. As with the foreign direct investment, the income derived from these assets, for example dividend on shares, is recorded in the current account. The fundamental difference between direct and portfolio investments is that the former are long-term investments, usually longer than a year, while the latter are short-term. Other investments include those capital flows that do not fall under direct or portfolio investments like loans by the World Bank. The reserve account is operated by a nation's central bank to buy and sell foreign currencies. Central banks use the foreign exchange reserve account to manage a country's foreign exchange risks, the value of its currency, and meet international financial obligations. For example, when there is an inflow of foreign capital, the demand for domestic currency increases, appreciating its value. The central bank buys some of the foreign currency from the market and holds it in reserve. In return, the central bank releases the domestic currency to stabilize its value. Conversely, when the foreign capital exits the domestic market, there is a glut of the domestic currency in the currency exchange market, depreciating its value. In this situation, the central bank releases the reserve currency in the market and buys the domestic currency, halting the fall in its value, stabilizing the exchange rate. Now we will briefly discuss why the balance of payments, by definition, balances to zero. In other words, this implies that a current account deficit must be accompanied by a capital account surplus and vice versa. Theoretically, this derives from the double-entry accounting principle. Under this principle, every debit entry in one account has a corresponding credit entry in another account. For example, when a country exports iron ore, it is recorded as goods credit in the current account. The credit payment from the importer is recorded in the capital or financial account as a debit. Let's understand this intuitively. If a country imports more goods than it exports, it runs a current account deficit. Since the country is importing more, effectively it is paying out more money than it receives from exports. To pay this extra money, the country borrows from abroad. This means foreign capital is flowing into the country, which creates a corresponding surplus in the capital account. Thus the current account deficit is balanced by a capital account surplus. This completes our description related to balance of payments. In the coming videos we will discuss about barriers to trade and the rationale and possible impacts of the ongoing trade war between the US and China. Stay tuned to the Knowledge and Learning channel.